Welcome back to the Scholar Advising Podcast. In today's episode, we're tackling 3 big money moves. First, we'll look at what to do if a large portion of your net worth is tied up in company stock. Next, we'll answer a question about 529s, specifically what to do when you're close to fully funded and what to avoid over-contributing. Finally, we'll dive into a question from a couple weighing the decision of whether to buy abroad. And as always, we'll wrap up with a rotating special segment. This week's term of the day is a CRT, or Charitable Remainder Trust. Let's get started with question 1.
I'm an exec at a large tech company with about 50% of my net worth in company stock. The stock has done very well, and I am planning to retire in the next 5 years. Should I start diversifying with my 10b5-1 plan when the next trading window opens, even though I am at a high tax rate, or should I hold off until my income decreases before divesting to take advantage of a lower tax rate?
So this is a tough situation that you're in, but a good one, right? You don't get to a high concentration without really high returns. So you've likely had high appreciation, especially with the big tech focus there. So we have to start looking at this from a risk perspective. Now it's really easy. I could come up here and say, well, you shouldn't have done that. You should have put all of your eggs in one basket, 50%. But you've got here for a reason that you had that high growth. So it's hard to necessarily knock that. It's been in the past. Now you're stuck with high concentration. It does lead to a high amount of risk. A lot of people don't take into account how much risk that a single stock actually has. When you look at the volatility of a single stock portfolio, you're looking at a 50% or so, 40-50% standard deviation. That's compared to a normal standard deviation or volatility of portfolio closer to 20%, 19%. So it's a significant amount of risk, but it's that risk increase comes from what is known as the idiosyncratic portion of risk, which is going to be the company specific risk that you can diversify away from by adding other stocks to a portfolio. That's the risk that the CEO makes a big decision the next day, whether or not the company is affected by any new type of regulations that come out. It's affected by any type of lawsuit that comes out. That's stuff that you can diversify away from that you're holding right now in the portfolio. So we know we want to start reducing that. The issue you have is you're in a high tax bracket now. So you start taking a bunch of this off of the plate, and now you're stuck with a high tax consequence. So for us to be able to get rid of that, I think you need to do so in a structured way over the next few years and to slowly divest. And the 10b5-1 plan makes sense for that. The only issue with the 10b5-1 plan, especially if you haven't done this yet, is it is not as easy as it sounds. 10b5-1 plans are ways for you to be able to exit out of the stock without having to deal with any insider trading, right? It's systematic. You go in and say, I'm going to sell X amount of shares this year of the stock. So that way everyone's on the same page. You're on the same page, the company's on the same page, and more importantly, shareholders are on the same page so that they know why their executive is selling stock and it's not going to be construed as insider trading. The only issue there, though, is that is not something that you have full control over. That is still going to require company approval and have these timing windows. So it's possible that you go in and say, hey, I would like to exit X amount of shares this year to reduce the risk. And they come back and tell you no, that they don't think that's a good idea. Whether that's a direct no or it's more of a subtle, we don't think that's a good idea, that you go out and start selling a bunch of stock, even if it is through this program. So keep an eye out for that situation and know that you may go in and say, you know what, thought about it, need to reduce concentration. I want to go sell 10 of the 50% that I have in the portfolio and then get approval, and they say no. So we're going to have to plan for that contingency. If you can't get rid of it, then as soon as you retire, it is going to make sense to reduce that holding. It may make sense to consider your retirement date as a possibility to help reduce the risk component. What I mean by that is if you're looking at retirement here in the next 5 years, it could make sense to retire in 2 years or sooner just for the benefit of having the lower tax bracket that you would fall into depending on what income you actually need in retirement. So I would take into account the taxes. I take into account the fact that the 10b5-1 plan may be denied, and the goal is in the right place. I think you really do need to start reducing the concentration here, whether it's through selling it now if you're able, or starting to give it to a DAF or gift it in other ways. And let's move on to then our next question.
We've been putting $12,000 into each of our two kids' 529s for a few years. The balance is now $90,000 and they have 7 to 9 years to go before college. I think we're close to around the balance we would need in there to cover college costs, and I don't want to overfund. Should we start putting those contributions into a different kind of account?
So a couple of things that we have to unpack here in your situation. One is the 529 balance now versus what we'd expect later. On average, you can expect a normal investment account to double in value every 10 years or so. Because it's a 529 and the risk of those assets is going to decrease, you obviously don't want a full stock portfolio 2 years before college starts, because then if the portfolio balance drops, then you can't delay college. You can't tell your kids like hold off for a couple of years until the portfolio bounces back. So what's going to end up happening is through their high school years, you're likely going to see the risk of that account drop. So the returns will drop as well. But on average, if you have $90,000 in there now, you're probably looking at average returns, even if we're at the 6% mark to account for the lower risk. That 12 years for doubling, so $90,000 now, maybe you have 150 in the accounts at time for retirement. Depending on where they're wanting to go to school and whether this is a public school choice, private school choice, that probably gets you a lot of the way there at $40,000-$50,000 a year. That covers 3 or 4 years. You'd be able to add some cash flow in. So I'd agree that you're probably close to being funded in that case. And we don't want to overfund the 529s. It's a restricted account. It typically doesn't provide a ton of tax benefits from a contribution perspective unless you're in a state that allows for state tax deductions. If that's the case, then you could do some of that. But assuming that you're fully funded, we don't want to overfund. If you ever do overfund it, there are options there, especially with the Secure Act. There's new rules around being able to roll a 529 balance into a Roth IRA, which could be really beneficial if that's something that you're interested in. For the kids, they still have to be eligible to a 529, but you could do $7,000 a year for the 5 years. And there's other rules around it with the account having to be open for 15 years and everything. But there are some pathways that didn't exist before if you overfund the account. Now, if we assume the account is fully funded and we don't have to worry about that, then the question is, you're still putting $12,000 into an account. Where else can you put it? So there are minor accounts, these UGMAs or UTMAs that you can start funding. Those are great options. One thing you have to watch out for if you start funding these underage minor accounts, that you're going to lose control of that money as soon as they hit the age of majority. In most cases, that's 18 for most states. So let's say you fund an UGMA account, Uniform Gift to Minors account, and you put $12,000 into that account every year for your kids. They're able to see this money grow. They have all these benefits, but they're 7 and 9. So now you're going to have 10 years or so of growth. That account is going to be worth probably at least $150,000 to $200,000 the time they get to the point where that account transfers directly to their ownership. So if that's the case, the question really comes down to, are you comfortable with your 18-year-old getting an account that's worth $150,000 plus at 18 plus a fully funded 529? I think that's a good move, especially if gifting in the future is a goal. It's an amount that is doable. It's trackable. It's a number that they could see and get used to, especially if you start now. That would be the big change from the 529 to the UGMA, is I would let them know that it exists and start getting them familiar with investing. And the ages are perfect, especially they start hitting 10, 11, 12. They start to have the kind of interest in money. You can start showing them the account's growing. It's not going to be a massive number that's in there. So they'll see $12,000 or $24,000 in the account that they can start helping you invest. Good opportunity to start talking about things like what are index funds, what's the market, how to invest, you can move up and down. And then when they get to the point of 18, then they can take control of that account. If you started to gift more than $12,000 to that account, you really start hitting the maxes at 38, then I'd be more concerned that no matter how much you teach them, receiving $500,000 plus by the time they're 18 is probably going to be a lot for them to take into account. And we'd want to start thinking about things like trust. But in your situation, I think you're right. You're probably fully funded. You need to start worrying about contributing that money to another account. Minor's account is perfect. and UGMA would be a great setup for it. And I don't think the amounts that you're contributing are anything that's going to set them up for a massive stressful event at 18 because of that amount. So now we can move on to our final question.
We've been spending the winter months in Cabo since 2020, renting the same place for a few months at a time while working remotely. We finally decided to price out buying there, and even with property tax, maintenance, and utilities, it would pay for itself after a few more years of wintering there versus renting. What else do we need to factor in?
So not uncommon that you find a vacation home, especially in a lower cost of living country, that the numbers work out. Now you look at it and say, we're spending all this money to vacation there, to rent a place. So why don't we just buy something? The issue you're going to run into are things that I would take into account is there's typically a big difference in what the lifestyle is going to be like staying somewhere that's already set up for you to stay, especially if you're looking at more of a resort area compared to a home that you're going to buy. The other factors are going to be things like your maintenance cost, insurance cost, everything that you would normally have for vacation home in the States, except it's going to be a lot more difficult. So can you call someone to do the maintenance on your house that you have down in Mexico? Can you speak Spanish? Do you have somebody there? Because if not, the option is you're going to have to pay a property management company down there that's familiar with working with you and knows different professionals that can work on any maintenance needs or any updates that you need down there. So not impossible on the maintenance side. It's just going to be at an added cost of you maintaining that home because you're likely going to have to be bringing in a third party. The other side is insurance. As soon as you start looking at different countries, the insurance rules are completely different. If something breaks, if the house floods, if something happens to it catastrophic, the coverage aspects are going to be very different. The ability for you to cover it is going to be different, and the quality of coverage can vary quite a bit in different countries. Now, the other aspect of this is the fact that you're still working. So because you're still working and you're wanting to stay there for an extended period of time, you want to make sure that you're not going to run into any visa requirements or any visa issues or remote work rules, even with Mexico or the United States, where residency is going to be based from a tax impact. I would expect, assuming that all is good, you say, fine, maintenance works. We have somebody down there who's really good, who's going to get us a good fee. We've already taken that into account. That all looks good. The cost of the home looks good. Everything's checking all the boxes, despite me saying all this. Then the last thing I would add in is that you're likely going to have a much lower liquidity factor and flexibility with the home. So not only are you locking in a vacation home, which always immediately reduces flexibility from vacations, but assuming that you've gone and said, that's the place we want to vacation and continue to vacation, that's fine. If the day ever comes that you no longer want to vacation there or you don't use it as much and you want to switch out homes or switch to a different country or whatever it would be, you're going to have a lot lower liquidity. You're not going to be able to sell the property as fast as you'd be able to sell a property in the US, and you'll likely take a hit. So not necessarily a knock on the whole plan, but there are additional impacts we're talking about from foreign ownership rules and the estate tax implications and foreign ownership concerns are going to be a big one that's overarching. Not only are you going to have your normal vacation home issues like we just talked about, but foreign ownership is going to be a concern. What are the rules there? Are you allowed to own property? What are the concerns? Are you going to have to make investments? It's very common for different countries to have rules that say, sure, you can own a property in our country as a foreigner, but we're going to require that you make an investment of $500,000 into some public organization, or you're going to have to make an investment in a business of $5 million at minimum before we allow you to buy a home in the area. So all of those need to be taken into account, which means now you're talking about foreign attorneys, CPAs that are familiar with foreign ownership and tax implications. So it's not just the ownership cost, it's the cost of all the other professionals that you're going to have to bring in to help you with this transition, with this ownership, whether it's the maintenance, whether it's the taxes, whether it's the attorney fees or anything else. And now we can jump into the term of the day. So this is where we take on a complex financial planning term, break it down into plain English. This week, we're talking about CRTs, or charitable remainders trust. So the idea here is that you have an irrevocable trust. So an irrevocable trust, typically you take the money, you go throw it into another account, and it's for somebody else's benefit and is no longer yours. So you don't have control over it. You don't have access to it. It's not yours. You're able to gift it away. One unique style of an irrevocable trust is a CRT. So the way a charitable remainder trust works is that you're able to put assets into this trust and then pull only income out of the trust over its entire life, and the remainder ends up going to charity. So basically you say, instead of a normal estate planning scenario that says, Steph and I have $10 million, I'm going to put it into account. We plan on living off interest and using this throughout retirement, and whatever's left is going to go to my kids. In this scenario, you go throw a couple $1 million into this charitable remainder trust. You're able to use the interest or any type of income from this portfolio. And then at the end of your life, the remainder would go to charity. What's nice about that is that now you can go put money into this charitable remainder trust, take the tax deduction for it today. It's going to be to charity. So you get the charitable distribution for it, but any income that you get over it, you're able to take out of the trust. So the way we see this used commonly and the way we use it is, imagine a situation where you have a portfolio that maybe you have a few $1 million in a concentrated position in a stock. It's actually very similar to what we were talking about in the first question. So you have a concentrated position in stock. You don't want to have to deal with the tax consequences of selling it right now. That's going to be a mess. But you could go take, say, $3 million of it and go put that into a charitable remainder trust. You get the tax deduction for that contribution, and then you're able to sell that stock immediately when it gets into the trust without the tax consequences. Diversify it now into, let's say, a total market fund like the S&P 500, and then use income from the S&P 500 or for any gains throughout your life, as long as whatever the remainder is sent to the charity. Now, there's some IRS tables and everything that require a certain amount be left to charity at the end, but that is a great way to, one, diversify away from a concentrated position, to still get income from the assets that you have, and be able to take a deduction today due to the charitable impact of it. And if you're charitably inclined, the remainder of it is going to go to the charity anyways, but you still get the benefit of income during that entire time. So really neat structure, really neat trust to set up. Again, that's the CRTs, or charitable remainder trust. And that's all we have for today. Thanks for listening. See you next week. Hey, this is Stephan Scheid. Thanks for tuning in to the Scholar Advising Podcast. If you have a question you'd like us to tackle on a future episode, share with us at scholarfinancialadvising.com/podcast. We'd love to hear from you. Until next time.
Scholar Advising is an independent, fee-only financial advisory firm focused on providing hourly financial advice. The information provided in this podcast is for general informational and educational purposes only, and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your financial situation, objectives, and risk tolerance. Thanks for listening.